Terrorism financing and money laundering are related but fundamentally different problems, and the CAMS examination tests that distinction precisely. Money laundering starts with dirty money. Criminal proceeds exist from drug trafficking, fraud, corruption, or another predicate offense, and the goal is to make them appear clean. The problem is the origin of the funds. Terrorism financing works in the opposite direction. The funds may be entirely clean in origin, raised through legitimate charitable donations, business revenue, or personal savings. The problem is not where the money came from, the problem is where it is going and what it will be used to do. A small donation to what appears to be a humanitarian cause can finance an attack. A salary transferred to a family member abroad can fund the purchase of weapons or materials. This fundamental difference shapes the entire compliance challenge around terrorism financing. Standard AML controls that focus on the source of funds will not detect terrorism financing when the source is entirely legitimate. What you are looking for instead is the destination, the purpose, and the pattern of movement. Particularly small amounts to individuals or organizations connected to sanctioned entities or known terrorist networks. Terrorist organizations use diverse methods to move funds. The formal banking system is used more often than expected. Small, apparently legitimate transfers, like rent or fees, often pass without triggering alerts because their purpose appears normal. Alternative remittance systems, particularly Hawala, are a significant channel. Hawala is a trust-based system operating outside formal banking. A sender gives funds to a local broker who contacts a counterpart abroad to pay the recipient. No physical funds cross borders. No conventional transaction record exists. The system relies on trust and debt settlement, making it extremely difficult to trace. The misuse of charities and NGOs is also significant. Donations for genuine humanitarian purposes can be diverted to fund terrorist activity. This charitable framing provides a cover that is difficult for financial institutions to penetrate during onboarding. Human trafficking and human smuggling are related but distinct crimes, both generating proceeds that enter the financial system, and both carrying specific AML typologies that compliance professionals need to recognize. Human trafficking involves the exploitation of people for forced labor, sexual exploitation, or other purposes. Victims are controlled through debt bondage, confiscation of documents, threats, or physical violence. The financial flows associated with human trafficking are distinctive. Third-party deposits into the victim's account, someone other than the account holder making regular cash deposits, are a significant red flag. Multiple payments from a single source to several different individuals can indicate that a trafficker is managing proceeds across a network. Payments to cash-intensive businesses, hotels, and transport services can reflect the operational costs of a trafficking network. Human smuggling, the illegal movement of people across borders for a fee, is a related but different offense. The migrant pays willingly. Environmental crime, illegal mining, logging, and poaching also generates significant proceeds increasingly laundered through trade-based techniques. Drug trafficking remains the predicate offense most closely associated with money laundering in the popular understanding, and for good reason. It generates enormous volumes of cash, primarily at the retail distribution end of the supply chain, and that cash must enter the financial system. The techniques used to launder drug trafficking proceeds are among the most well-documented in AML: smurfing, structuring deposits across multiple accounts and individuals to stay below reporting thresholds, blending criminal proceeds with the revenue of cash-intensive businesses such as restaurants, car washes, and convenience stores, and the use of currency exchange houses and money services businesses to convert cash into other instruments. Drug trafficking is a global industry, which means the proceeds move internationally, creating cross-border layering patterns that require both national and cross-border intelligence to trace and disrupt. Bribery and corruption deserve separate attention in this context. Corruption generates proceeds that are especially insidious precisely because they do not look like criminal proceeds. A corrupt payment is typically made from a government or corporate account in a documented transaction. The corruption is in the arrangement, not in the surface form of the payment. This is why politically exposed persons, individuals with public functions, receive enhanced due diligence, not because they are corrupt, but because their position creates both the opportunity and the cover for corruption-related financial flows. The consequences of financial crime operate across three distinct levels, and the CAMS examination specifically tests understanding of each level separately. At the social level, the consequences are the most profound and the most difficult to quantify. Money laundering allows criminal networks to survive, reinvest, and expand. Drug trafficking organizations that successfully launder proceeds can fund larger and more sophisticated operations, corrupt law enforcement officials and politicians, and exert influence over entire communities and economies. Proceeds from human trafficking that reach integration sustain the exploitation infrastructure that makes the crime possible, the recruitment networks, the transport routes, the accommodation facilities, and the enforcement mechanisms used to control victims. Environmental crime proceeds that are laundered fund the expansion of illegal mining, logging, and poaching operations that destroy ecosystems at scale. ML makes all of this possible. There is a direct and traceable line between the quality of AML controls in the financial system and the scale of the organized crime it enables or constrains. Every suspicious transaction report that is filed accurately and on time is a contribution to disrupting the financial infrastructure of criminal networks. Every filing that is delayed, inaccurate, or not made at all is a gap that criminal organizations exploit. The social consequences of financial crime are the reason the job exists. At the institutional level, the consequences of financial crime compliance failures are severe, multidimensional, and in some cases existential. The most visible consequence is the regulatory fine. Fines for AML failures by major financial institutions have reached the hundreds of millions, and in some cases billions of dollars, imposed by regulators in the US, UK, EU member states, and across multiple jurisdictions simultaneously. The Trésor case we examined earlier, €1 million for a single French EMI, represents the lower end of the enforcement spectrum. But the fine itself is rarely the most damaging consequence. Regulatory sanctions beyond the fine can include requirements to cease onboarding new customers, to remediate an entire AML program under regulatory oversight, to appoint an independent monitor, or, in the most serious cases, to surrender the institution's license to operate. Reputational damage is a separate and compounding consequence. An institution named publicly in an enforcement action faces immediate questions from counterparties, investors, correspondent banking partners, and regulators in other jurisdictions. Correspondent banking relationships, which are essential to cross-border payments, can be terminated by counterpart institutions that no longer wish to carry the reputational and compliance risk associated with the named institution. Finally, operational and legal risks are generated by AML failures that extend well beyond the regulatory process, including civil litigation from affected parties, and the operational burden of managing a major remediation program while continuing to run a business. At the individual level, the consequences of AML compliance failures extend beyond the institution to the people responsible for them. The compliance officer, the money laundering reporting officer, and senior management can face personal accountability that is separate from and in addition to any action taken against the institution itself. The most common form of individual accountability is regulatory action, a determination by a supervisor that an individual was not fit and proper to hold the role they occupied at the time of the compliance failure. A finding of this kind typically results in that individual being barred or restricted from working in a regulated role, sometimes across the entire financial sector and sometimes across multiple jurisdictions. In more serious cases, particularly where there is evidence of willful blindness, deliberate circumvention of controls, or active assistance in financial crime, individual criminal prosecution is possible. Several jurisdictions have prosecuted compliance officers, executives, and relationship managers, not just for failing to prevent financial crime, but for actively facilitating it. The standard of willful blindness is important to understand. It does not require proof of actual knowledge. It requires proof that the individual deliberately avoided acquiring knowledge that they were legally required to have. This standard means that an MLRO who declines to investigate a pattern of alerts that clearly warranted investigation can face criminal exposure, even if they never knew precisely what the underlying crime was. Financial crime risk does not exist in isolation within an institution's risk framework. It intersects with and amplifies 4 other major categories of institutional risk, and the CAMS examination tests understanding of those intersections. The first intersection is with operational risk. A financial crime event, a significant fraud, a money laundering scheme running through the institution, a sanctions breach, is simultaneously an operational risk event. It represents a failure of processes, systems, or people, and it triggers the operational risk reporting and remediation mechanisms alongside the AML response. The second intersection is with legal risk. When an institution facilitates financial crime, even unknowingly, it may face civil litigation from affected parties, regulatory legal proceedings, and in some jurisdictions, criminal liability at the institutional level. The legal risk dimension of financial crime can persist for years after the underlying events. The third intersection is with concentration risk. An institution that has allowed a significant volume of suspicious activity to flow through a particular customer segment, product, or geography has a concentration of financial crime risk that is simultaneously a concentration of regulatory, reputational, and legal exposure. The fourth intersection is with reputational risk. An institution's reputation is its license to operate in everything but the formal sense. When that reputation is damaged by association with money laundering, corruption, or terrorist financing, the consequences flow through every commercial relationship the institution maintains. To consolidate the full picture of financial crime risks and methods, it is useful to build a mental framework that connects predicate crimes, the money laundering typologies they generate, and the stage of the laundering cycle at which detection is most likely. Drug trafficking generates cash that is most detectable at placement, in structuring patterns, cash-intensive business deposits, and conversion through currency exchanges. Human trafficking generates proceeds that are detectable through third-party deposit patterns, multiple individuals receiving payments from one source, and spending patterns inconsistent with the account holder's stated profile. Corruption generates payments that look legitimate but become detectable through enhanced due diligence on PEPs, particularly the source of wealth and source of funds analysis that EDD requires. Fraud and cybercrime generate proceeds that move at speed through mule networks, detectable through rapid receipt and onward transfer, short account tenure, and transactions with no clear customer purpose. Terrorism financing is detectable not through the source of funds but through the destination, small payments to sanctioned or high-risk recipients, geographic patterns associated with conflict zones, and connections to known terrorist networks. Each of these typologies informs a specific set of transaction monitoring scenarios, a specific set of customer risk factors, and a specific set of red flags that the compliance professional is responsible for applying. The CAMS examination will present scenarios in which you must identify the typology, the predicate crime, and the appropriate response. That identification begins with the foundation we have built across these two lessons. 2 lessons, 9 blocks each: money laundering mechanics, predicate crimes, terrorism financing, financial crime types, and consequences at every level. The foundation of financial crime risk understanding is now in place.